I say this, and I want to put an emphasis on this, especially for our listeners who are in the short-term rental world. This is exactly what is happening right now in short-term rental investing. We just went through a period right after COVID where everybody and their dog thought they were a genius. And if you had a short-term rental, it was like having toilet paper during COVID. It was the hot topic in real estate. It was the hot investment to put your money into, and everybody was doing it and everybody was making money. Now everybody's looking back and saying, well, what happened? Market changed. The Airbnb, it's Airbnb bust. The golden age is over. No, the bad habits that you learned during that time and rode that wave, you have to actually operate this as an actual asset class like you always have.
Hi, I'm Wyatt. And I'm Grace. And you're listening to our dad and your host of the Vacation Rental Revolution podcast.
What's up, guys? Welcome back to another episode of the Vacation Rental Revolution podcast. I'm your host, Shawn Moore, and we're back with our newest episodes that we're adding in on a weekly basis, and we call these Experts Corners. And so this is where we find experts in the real estate industry, and we ask them to come on and have conversations about what they're doing and how they're, really helping people raise the bar and raise the level of their play in real estate investing. Today, we've got Mr. Hunter Thompson on joining us, and Hunter is the founder of raisingcapital.com and ASIM Capital, where he's raised over $100 million, a lot of money. He's also the host of Raise Fest. It's the #1 conference for people who want to raise more money. And he's also the author of a book that I got a little while ago called Raising Capital for Real Estate, a really good book that you can point, and also the host of the Cash Flow Connections Real Estate podcast. Hunter, you got a lot going on, my friend, and you've done a lot. I appreciate you joining us and being willing to have this conversation today.
I'm excited about it. Honored to be on.
Yeah, it's gonna be really fun, you guys. Hunter is a really great expert in raising capital and has a really good story of just starting from not coming from the raising capital world, right? So Hunter, I always love to start these conversations with just getting the backstory, what got you started, what got you interested in this, and then we'll talk about the details of, obviously when you're investing in real estate, raising capital is a common theme and a very hot topic, and so we'll dive into that as we kind of figure out what got you interested in starting this in the first place.
I mean, there's so many ways I can take that. The thing I'll start with is I was at a very young age, very inclined to figure out unique things about money. When I was 5 years old, my mom lived near a very popular concert venue, and I realized that there was probably an opportunity to sell some parking lot. I kind of figured intuitively, hey, someone will probably pay us $5-10 to park in our parking lot. Hey, mom, will you split this with me if I spend the day selling parking spaces, And so that was my kind of intro into making money. I remember making my first $100 doing that and just being we can buy anything. Toys are so cheap back then. This is unlimited. But I got to be honest, as I was going through school, I kind of started to accept that I was a bit of a slacker. And I think it's because school was just such a misrepresentation of what it means to make money and do business. And so it's the only thing you have to measure yourself by for some people's perspective. And for most people, it's very important that you do well in school. And so when I was kind of doing school, what's the minimum I can do to get by, it had an impact on my psyche. And I literally remember there was a class in microeconomics in college where I had sludged through the semester, just going to the labs, but kind of not really being there mentally. And at the end of the semester, I calculated that I had to get a 76 on my final to pass. And I went into the final, took the test, went home, logged in to check my grade, and I literally got a 76. And it was literally like that scene in Billy Madison where I was I am the smartest man alive, because that's what I was trying to optimize for. What's the minimum I can do to squeak by?
Right.
And that kind of messed with me. I thought it didn't at the time, but it messed with me. It took me years to do these cool things that we're going to talk about today to uncover that, no, I'm not a slacker. That was just a really poor ruler to use to determine my success. And when I look back, there was other things I did where I didn't do the minimum. Running for me, cross country and track, something that I took extremely seriously at. I think at the time in high school, I didn't end up running for a college, but I definitely, was recruited by Division II, Division III kinds of colleges, maybe not Tier 1, Division I kind of groups. But regardless of that, it didn't matter. My identity was that of a runner.
Right.
And so that's what I realized. That's how you make money, is you have an identity shift of, I am about that life. I don't run, I'm a runner. And so now it's like, I brought that intensity into business, entrepreneurship, raising money, and that is who I am. That's the lens through which I see the world. So to answer your question directly, got out of college right in the peak of the Great Recession and knew it was going to be a great time to go all in on real estate. And that's what I did. And that's what led me to this conversation today.
Love it. Love it. And I love the, where you say, hey, that was your identity in the running world was, hey, I'm a top tier runner, and you set the bar at a certain level. I always talk about, and I hear Ed Milet say, you'll never outperform the standards that you set for yourself, right? It's like a thermostat. You set a thermostat at a certain level in a house, and the temperature is going to maybe go up above it, but it's always going to come back down to that thermostat level. And that's the standards we set in our lives. And what I think that people don't realize sometimes until we sit down and think about it is we set different standards in different areas of our life, right? When you're going to school, your standard was passing, right? And it didn't mean that your standard in life was just passing by and being average. You had standards in the running world that were really high, and you set the bar really high there because that was your identity. And I think when we really are intentional about, okay, I'm going to set standards with my family, I'm going to set standards with my business, I'm going to set standards in my investing. And if we really think about it and we set those standards at a higher level, we will achieve those levels. Just like you said, there's, it's pretty amazing when, and we all have stories of it. You say, I need to get a 76 on this test to pass, and you got exactly a 76, right? It's no different than in business. You say, hey, listen, I've got to hit $1 million for this year. And you've never done it before, but that's what we have to do. You will do it, right? But you're not going to hit 2 million. Right. And so whatever those standards are, we tend to gravitate toward it. And so, so at that time you started to say, I'm curious, because during contractionary times, during the Great Recession, and I've been investing full-time real estate since 2000. So I've seen a lot of ups and downs. I was 8-9 years in when the Great Recession happened. And during those times, most people are not looking at those times through the lens of opportunity. They're looking at it saying, I need to get out of this. This is not the right time to be in. You just mentioned that you kind of looked into this right in the middle of that. And I'm curious because it's very, it's not normal to look at those times and say, I'm jumping all in. And so I'm curious, did you have a mentor? Did you have somebody that opened your eyes to that? Or like what opened your eyes to that type of an opportunity during that time?
Well, I'll be honest with you, man. And so I'm 38 now, and I've learned so much in the last 15 years or so. And one of the things I learned is just this massive humility. And I'll circle back on that in a second. Now, one of the things I'll say is that we all have to leverage our natural inclinations and figure out where they are, find out where your biases are, be careful of that, but lean into your strengths. And so for me, going right when everyone's looking left was never a problem. So when I saw blood is in the streets, that wasn't like something that was difficult for me. And I want to highlight this because we all have different strengths. This is just mine. And it just happens to be very well suited as an investor. So it's easy to say, I'm going to go right when everyone's looking left. But like, think about it. I'm a college graduate with no job. I'm just going to do my own thing when everyone is seeing this is a massive tailspin of foreclosures. There's never a worse time to invest in real estate in the history of this. That's the kind of mentality of like what
those
most
are the headlines,
thought.
right? Yeah.
And so that's what my friends and family thought. And these aren't random people I hate that despise me. These are people that care about me and have been rooting for me my whole life. So like, that's what you got to think about when I say I'm going right when other people are going left. But the reality was my intuition that it was a good time was something that was so strong that it didn't even really bother me. It was more like I think we're going to see how this plays out kind of scenario. Now, the other side of that though is the humility, which is that it was very fortunate about how the age I was when I graduated college. The fact that I wasn't heavily invested in 2006 and learned a lot of the wrong lessons in 2004, 5, and 6 in the lead up to a massive crash. Would I be standing here if I was 5 years older? I don't know, right? Yeah. It's hard to say you started your career at the most favorable time to invest in real estate in the history of a country, but I'm pretty confident that might be the case.
Yeah.
But one more piece of humility that I want to be honest about. It's not just the market conditions that created this massive opportunity for me. It's that the market conditions wiped out a lot of bad ideas. Yeah. So when I went to go build my network, the people that I was surrounded by were people that were still standing. And so in California in particular, which experienced about a 40% reduction in prices overall, I got to be mentored by top 1% type of people that were implementing tried and true strategies that most investors were not implementing, AKA syndicating deals, buying really quality assets, not fixing and flipping deals without even adding any value to these properties. That's not who I got mentored by. And I got to be very grateful for that, because if I had started in 2005, we had people with no social security number flipping houses. The example they gave in The Big Short, there's a guy getting a lap dance. The stripper's like, I've got 5 houses. It's like, that was the situation. So maybe those were going to be my mentors, but I'm very fortunate and got to be serious about the fact that that wasn't my path. And I just had to maximize what was actually in front of me.
Love it. I love those last 3 minutes that you just talked about. You guys that are listening, rewind it. It is a huge point and a huge lesson. There is, especially on the part of the mentors that were around, because those people got wiped out during that time. They weren't around, right? The people that were just, they're riding the wave. And it is very, very common in real estate. I remember I started my career as a fix and flipper. So in 2000, I started fix and flipping homes. I was doing it for 6 years full time. That's all we did. We started getting into development deals. But during that time, I remember in 2005 and 6 and telling Teresa, I'm like, what is going on? Because we would buy houses, old houses, dilapidated houses. We'd go in, we would actually fix them up. It would take us 3 to 4 months, and they would be completely gutted. We bring them back to life, and we would take in these areas, and we would actually go buy multiple homes on the same street and turn them from, rented areas and mostly tenants to mostly homeowners. And so the cities were loving us, and then during that time, people were going and just buying houses, doing nothing with them, not even putting carpet and paint in them, and flipping them for almost the same amount of money as I was making. I'm like, what am I doing wrong here? Right? Like, what is going on? And the point of all that is they were learning really bad habits of being able to maybe take advantage of the market, but a lot of them got caught with their pants down, right? They got caught holding the bag they were in over their heads. They didn't know what they were doing. They learned bad skill sets. I say this, and I want to put an emphasis on this, especially for our listeners who are in the short-term rental world. This is exactly what is happening right now in short-term rental investing. We just went through a period right after COVID where everybody and their dog thought they were a genius. And if you had a short-term rental, it was like having toilet paper during COVID. It was the hot topic in real estate. It was the hot investment to put your money into, and everybody was doing it, and everybody's making money. Now everybody's looking back and saying, well, what happened? Market changed. The Airbnb, it's Airbnb bust. The golden age is over. No, the bad habits that you learned during that time and rode that wave, you have to actually operate this as an actual asset class like you always have, except for those 2 years. And there was a lot of the majority of the market jumps in. People always say, why do you agree with people when they talk about the Airbnb bust? I said, because it's true. It is a bust, because 80% of the people in this game right now don't make a lot of money. And Hunter, I'm sure you have talked to people in the short-term rental world that, you're in the real estate investing world, and there's plenty of stories saying, man, I'm not touching that asset class right now, right? And it's because what happened is there was a lot of really, really bad habits that a lot of people because short-term rentals, that's really when they became really, really popular. They became mainstream during that period. And now the dollars on the consumer side continue to go up and people are spending it. But a lot of operators really don't know what they're doing because they're getting mentored by people that literally are still wet behind the ears. They got into this game at the wrong time, not the right time. And I love that you said and you recognized that the right time was during the hard time. Because when you can enter a market during a harder time, not riding the waves, you're going to learn a lot better skill sets. You're going to understand how to actually run whatever business and skill that you're trying to do. And you're not riding the wave of just the popularity of an asset class or the wave of the real estate markets or the money markets or whatever it is, right? And so it's a really important point that I think you made right there. And I appreciate you bringing that up. It's interesting when I love these conversations because there's always so many nuggets of information. I never know where they're going to go because they're just conversations. And that is one of my favorite points that anybody's made on this show. And we're 4 years into it, right? And it's really fun.
Well, listen, man, the rational conclusion to that, though, is what maybe some of your listeners aren't prepared for, but they should be thinking about it like this. When I tell people when I started and they look at my track record, they go, well, dude, that doesn't count. That's 2012. It's like, those are the kind of deals your niche is doing right now.
Right.
They're so good where people go, holy crap, that doesn't count. Well, I'll tell you where it does count. In your bank account and in where your investor's bank account. It's so good, it doesn't count. That's how good it is. And so like that to me, I don't care about what people say about whether it counts or not. I'm trying to do those kinds of deals because the best thing about this is I've done deals in all stages of this climate, and I've done deals that have gone sideways because of interest rates and had challenges. I've done enough in this industry that I've had some horror stories. But what you really want to do is you want to do deals that it's really hard to find a deal. It's hard to raise the money, and then you close it and then you just coast for 5 years. Yeah. That's the kind of, in your niche, that's the kind of deals I'm imagining people are going to do right now.
Yeah. And understanding saying no to, I mean, we say no to 95% of the deals, right? Because we're looking for the right deals. And I'm curious on your thought of this. And then I want to get into some of the nuts and bolts of raising capital. You've been around long enough. You've been in different, asset classes, looking at deals, and you've talked to a lot of people. You raise money. You talk to investors. And one of the things that I cringe at is when somebody says, I've got 100% track record. And, when they've never had a bad deal, I feel like, one, they probably haven't been in it long enough. They may not be the right operator because they might not have the experience to understand how to deal with some of the challenges. We want a high success rate, right? We want to have a really high success rate by being really diligent on the front end. But I can honestly say, and it sounds like you can say, but we're not batting 1,000 either. And that we're batting enough that it works really, really well for us. But things happen. And every time we have a deal that doesn't work out the way that we want it, we learn more. We understand how to avoid some of those mistakes. And it just adds more knowledge and more tools in our tool chest as we move and continue to move forward. And I always am nervous when I hear somebody, because I get approached actually as an investor all the time saying, hey, will you invest in our deals? And one of the first red flags I get is when somebody says, will you invest in a deal? I've got 100% track record. You're never going to lose money. I always get real nervous. And I don't invest that way, but I get approached that way a lot.
Well, that's the thing. And we'll talk more about raising capital, but like the truth of the matter is it's trust over track record. And so if someone's trying to hammer their track record and trying to make guarantees about future projections and performance, the reality is they're leaning on the wrong things. They should be leaning on your relationship, the emotional connection you can build, their due diligence process, the systems and the processes behind the results as opposed to the results. And also, from a gut feel perspective, do you want to be connected for the next couple of years? Yeah. And so we can talk about how to paint that story. But for me, I've helped a lot of people go from never raised $1 to raising millions. And so they have no track record when they get started and they're able to do it. And there's some tricks and tips and we can talk about all those. But the point is, people that over rely on track record, then you're just competing on whoever has the longest track record. It's like you're going about it the wrong way. And sure, you can wait 20 years to compete with me, or you can use a couple of the strategies we'll talk about today to skip a lot of that and connect with connect with the investors more emotionally, by the way, which they should be because they are investing in you, not the property. And, there's a system for all that.
Yeah. Well, let's go there a little bit right now. I think it's going in this direction where you kind of explain the difference between raising capital and a really good operator, right? Yeah. And understanding how to bring in that partnership and what that even means.
Sure. So and part of this, to be honest with you, is probably just because I talked about when I started, right? So people got wiped out. And so my first mentors, the true north was about diversification. Diversification out of the stock market. And so that is a good true north as an investor. And so what I thought a good business model would be, and there's definitely some truth to this, is I said, okay, look, I've uncovered this world of syndications. Now, a lot of your people probably know about this term, but at the time, 2010, 2011, it wasn't even legal to talk about investments in syndications on the internet yet. It wouldn't be until 2013. So I was going around to people and being like, I've uncovered this unique thing. It's called basically crowd-funded real estate, where we can pool investors together to buy larger, more quality assets. And I found an operator that's handling all of the due diligence and the dirty work, and they've got relationships with the lender, and they're the ones selecting the insurance and dealing with the property manager. And they've got, a significant track record. And what I want to do is partner with them by bringing money to the deal. And the way that I did this was I went to them and said, hey, listen, I know you're not going to make me a partner on this deal because you guys already have your partners and you're good to go. But what if I just created what's called an SPV, a special purpose vehicle, a feeder fund, an LLC, and pulled 10 investors together to just invest in your deal, would you give better economics to that LLC than a normal 50K investor? Because if I show up with $500,000, $1 million, I'm going to make your life a lot easier. I'm just going to be a typical passive investor, but I'm going to do it through an entity. Does that sound like a good deal to you? And this operator was like, yeah, man, we'll do that. We'll give you like about 30% better economics to that LLC than if you were just a typical 50K investor. I said, cool, I'll be right back. Then I went to 30 people. I said, I got a great opportunity. It's not even me doing it. I found a great operator that has a great track record, and this is my first deal, but you don't have to trust me. Look at them, look at their background, look at the deal. And it really was a sweet deal. It went on to produce 20% plus returns. So my goal was to raise $500,000. I basically promised that operator that I would do that. I got 30 people in a room, all accredited investors, wealthy people. I'm very fortunate that I knew some wealthy people. And my goal was to get 10 of them to invest 50K. And I gave this presentation, and you read my book, so you know that I gave this awesome pitch, one I'd give today, and it fell flat. And I didn't raise $1. And so that was the idea, but it fell flat. And I basically was like, okay, what went wrong? Took me probably 6 months of crying and complaining. I got back on my feet, implemented a lot of the systems and strategies that we can talk about, but ended up pulling it off. And I didn't talk about this in my book, but I did end up pulling it off. It took about 6 months, but I did pull 10 investors together. I got $500,000 or $640,000 technically, and we did it. And that was my first investment opportunity as a capital raiser through what's called a fund of funds. Yeah. And the goal there is that I was supposed to just administer the fund of funds and not be responsible for actually operating the real estate. Now, for context, I did that for around 10 years or so. Raised around $50-60 million doing that with different operators in different niches. But in 2022, I started, what I wanted to build had grown beyond my imagination, and my knowledge of the industry had grown. And so now when you compare operators, like what at first I thought wouldn't be a big deal, now I know the industry deeply and I'm an expert in the industry. So I wasn't willing anymore to defer to someone else's expertise. And I became an operator in 2022, got an operational partner. And now we just buy deals just in Phoenix, just in multifamily. So now if you're an investor or a fund of funds manager, we can be your Phoenix group and we'll handle all the dirty work. Yeah. And you can just be a capital raiser. But that's kind of the delineation between the two.
Yeah. And I love it. And I think it's really important because people that I talk to, and I think I told you this before we hit record. I hope I'm not repeating myself on record because you and I said this, but I always say there's a lot of people who come to me and say, I think I'm going to start a fund. I think I'm going to raise this money and I want to put it into these asset classes and I'm going to do this. And I'm going to be the operator. Their idea is it's one in the same, right? I'm going to raise the money and I'm going to be the operator as well. That's how I'm going to add value to the deal. And I said, that's a huge responsibility when you're the operator, when you don't have the experience as an operator, right? And I think that is a stepping stone. Would you agree that it's and it sounds like, it's the path that you took. You became a capital raiser at first, became an expert in the industry, were part of tons of deals, understand what it is. Now you become that operator. Yeah. In my opinion, that is where the experience does matter. We all have to start somewhere, but we have to start in the capacity that one is responsible for ourselves and our investors, especially when you're talking with other people's money. There's a way higher level of responsibility when you're dealing with somebody else's dollars than your own dollars, right? And then being able to say, okay, now I feel like I'm graduating to the operator, where I feel like a lot of individuals, and I'm curious, you talk to a lot more people that are getting into the game. Do a lot of people assume, because the ones I talk to and asking me about this, they want to be one in the same. They think it's like, I'm going to raise capital, I'm going to be the operator on this deal, and then I'll go find the deal, I'll do it, and that's how I'm going to make my money. And where I love that you say there is a major difference between the two, and they can be separate for a long time. You made money doing this, raising $50 to $60 million before you became an operator, and now you're doing both.
Yeah, I'd say that there is definitely something to what you're saying. So, for me, number one, I really liked initially the fact that it was a hyper high leverage activity. If I could raise $500,000 once and then essentially just administer an SPV, which means issue distributions and tax documents for 5 years and then make around 10% or so of what I raised, that's a good way. If I raise $1 million, that means I make 100 grand in the 5th year or something like that. Some people are like, well, that's only, 20 grand a year. Yeah. But all I did was like, a month of work. And then I can go and do it again and again. And that's what I did to raise like 50 or 60 million that way. But I mentioned at the beginning that diversification was my true north. One of the mistakes I made to anyone that's thinking about doing this is that that's a good true north from an investor perspective. But if I were to do it again, I would be thinking about this. If I'm going to partner with someone, I would need to be willing to bet my career on them, because you are, whether you know it or not. Yeah. So and the market demanded this, right? Like I would raise money for mobile home parks, and eventually people would be like, you got anything else? Got anything different? I'd look for other things. I mean, it's just like normal business. Right. And my due diligence process, the reason this is an important piece is that my due diligence process is like head and shoulders above other people at the time. Throughout my career, I was asked to speak over and over again about what we did to vet operators. And, in the 10-year period or so, I probably did deals with less than 10 groups. But even still, I think that's too many. I think if I were to do it again, it'd probably be like 3. And know that during a 5 and 7 year hold period, one of those 3 may disappoint you and you never work with them again. So just think about that. Now, the other piece, though, is that sometimes people they have a W-2 job that's fairly demanding. And they're like, how do I get into this game? That's a great way to get into the game, is to find the other people that work with your W-2, find a great operator. You got 10 dentists that work with you. Great. Pull the 10 dentists together and go invest with Shawn. And now Shawn's doing the dirty work and you can kind of continue your W-2. And if you want to, you can call what I say hybrid your way out of your W-2 by first being a capital raiser, learning about the business, and then eventually graduating if you want to.
Yeah. Love it. I appreciate you going down that road, because in my conversations a lot, it's, people don't think of the two separate as much. And I think I partner on deals. I told you I don't raise capital. I guess technically I've never actually raised capital, but because we've been in this game as long as we have, I have people all the time to say, I'll partner with you on a deal. We've got a partner program where I take equity in the deal. We find the deal, we do the due diligence, we get it set up, we operate it, we do that for people. But I partner with individual investors that come to us. So I've got a 2-year wait list on it, right? It's not and so it's similar to that. And so there are multiple ways, right? The sky is really the limit on how partnerships are formed. But let's talk, there's still so many options when you're raising capital. Like if you're saying, hey, listen, I'm going to raise capital for a deal. There's raising, debt is different than equity, JV partnerships, syndications you mentioned. And I know that we can't get into all the details on them. And you guys just go get Hunter's book, start following him on social, listen to his podcast. You'll get a lot more educated really quickly on this. But at a high level, talk about some of those differences and what your preferred method is when you're raising capital on deals.
Totally. So 2 things. One, I'd say is I'm going to try to give as much detail in terms of the timeline. We have an event that's coming up. I freaking would love to see all of you there. It's called RaiseFest, RAISEFEST.com. Check it out. Some incredible speakers, billionaires, $100 million capital raisers, et cetera. So one of the things we're going to talk about, though, is the different ways to raise money. One of those, the most simplest way to raise money is as debt. And in real estate, we call these hard money loans. Hey, listen, I'm going to buy this $150,000 house. I need to borrow $100,000 to buy the house. And then I'll put up the extra 50 or something like that. So you borrow $100,000, you use the $150,000 house as collateral. And if you basically pay the investor, the lender, a monthly mortgage, a monthly note, and if you don't, they foreclose and take the $150,000 house, right? So that's using debt as a real estate play. The next more advanced—
Really quick, can I interrupt you there, Hunter? So on debt, and this is something when somebody you mentioned hard money loans, bridge loans. There a lot of times when you're raising debt in real estate investing, it's much easier to raise short-term debt money than it is long-term debt money from private sources. And I think that that's important for people to realize as well. It's the banks are there for the long-term debt. Honestly, that's kind of what the banks are there for. And it's harder to get long-term debt from private sources because the returns aren't real favorable for the private lender. They can get better returns somewhere else, right? And so I always have people ask me, well, because we're in the long-term game, right? We're buying properties, holding them for at least 5 to 7 years, sometimes longer. And it's harder to raise debt when it comes to that, unless you're just a huge debt fund, right? And so for individual investors, think of debt. A lot of times I always say short-term versus long-term money. If it's short-term, debt is something that you may consider, but it's because the returns are favorable for the actual money investor. Long-term debts is a little bit less favorable, so it's harder to find that out there.
Yeah, 100%. And usually, it's something like an 8, 10, 12% interest rate.
And it doesn't work for the deal.
On a monthly basis. And then, like I said, if you don't have success, you don't pay the monthly mortgage, the investor gets to do it. But it's a very simple way to structure things, and you don't have to really explain much to them.
Yeah.
You don't even have to, they don't even have to think you're really going to be good at it, because if the value of the collateral is worth more than what they're investing, it's kind of a no-brainer, and it's an easy way to raise money. But you start to hit a hurdle because, you can raise 100,000, but what about 300,000, $500,000? Now you start to get into getting multiple investors involved. Or another hurdle that will come up is that investors like, look, I'm not happy with like 10 or 12%. Yeah. I don't care about cash flow. I'd like to have a higher return. I want to truly partner with you on this deal. And like, maybe we can split the profit or something like that. That's where you get into the next stage of raising money, which is joint venture, where in this case, it's usually like you, the owner operator, buying something and doing a business plan with real estate or non-real estate. And you've got like one investor, and both of you have like pretty similar amounts of control. You might be the one doing all the work, but like in the sense of who makes really good, important decisions, both people will probably be involved. And the reason I say that, if I can kind of skip to the next one, is that the SEC, which is the organization which basically is the regulatory agency regarding investments, they view that element of control as material, because we're kind of on equal footing if it's me and you and we're doing this deal. But imagine a scenario where there was 100 investors, and their thing is that they don't want to be involved in the details at all. They just want to defer to your expertise. That's when you get into the third way of raising money, which is crowd-funded real estate, or the formal term is syndications. And when you do that, where you give up control, where you defer to a third party, you are creating a security. And this is a material change in like the legal structure and the level of sophistication of the legal documents, but it allows you to raise money from 100 investors. Yeah. And so the three, again, are debt, JV, and securities or syndications. There may be some others out there, but those are the main that most people use.
Yeah, love it. And I love the breakdown, because there are a lot of options. But like you said, as you grow, as more people get involved, there's levels that you have to step up to. Really, like you mentioned, the SEC, you can only do, JVs are going to, they're going to be a red flag if you have 100 people on a JV deal, right? Because not everybody is on equal footing, even though it may be structured like that way. They're going to look at it and say, no, that's a syndication. There's more responsibility here. You've got to do different things. And so that's why really when you're raising money, it's really important to be educated on this kind of stuff as well, and surround yourself with mentors and coaches that have done this before, because you got to be really careful. Sometimes you can get in big trouble, right? You can get, to where it's prison time if you don't do it right, when you start to raise money from a lot of people. That's
true. And the thing is that this whole industry is done behind closed doors. This is a private market. And so you can do wild stuff that's totally out of line, but nobody knows. But what happens is when deals go wrong, everybody has to reveal what happened. And then all of a sudden, everything goes wrong. So it's weird. It's a unique business where you can do things that you think are right for like 5 years, 10 years, and you have a significant correction, and everybody gets caught at the same time doing something, this, that, and the other thing. And anyway, it's kind of like a scary part of the industry, because the laws are very difficult to understand, but that's why people leave it. That's why it's lucrative. That's why it's such a high leverage industry, is because you can make a lot of money during that 5 and 10 year period. And especially when things go wrong, because that's when you buy your best deals.
Yeah, absolutely. And so let's touch on really quickly too, as far as, a big question is like we invest in short-term rentals. I mean, that's where a lot of our audience is interested in. You said that you guys are in multifamily at this stage in Phoenix. You've done a lot of different types of deals, looked at different deals, but I'm sure when you go to Raise Fest, you talk to investors that are in all kinds of asset classes, right? And so the question is, when, what are the right asset classes to raise money for, right? We hear about multifamily a lot. We hear about commercial property. I hear about mobile home parks a lot. And there's different, every asset class has pros and cons to invest in. There's different reasons you would do it. And the technical answer is you can raise money for anything, right? Mm-hmm. However, you said it really, really good that the more moving parts there are in the investment vehicle, the more, that it's going to be kind of set up and, for an operator, a best in class operator to come in and add value to it. So if the more levers there are for an operator to pull to add value to a deal and not just market dependent, the better, maybe the more opportunities and the more lucrative it could be for investors and raising money. And I love that. I mean, it was right when you were, I like reread that page of your book a number of times, right at the very beginning, just to say, if there's a major market advantage because it's a very complicated asset class, the more complicated the asset class is for the average person to go in and get into, the more willing they're going to say, hey, listen, I want to be in this asset class, but I'm not an expert. I need to find those experts. And you use the example of single family investments, single family, long-term rentals. There's just not a lot you can do. If you've got a 3-bed, 2-bath in Phoenix and, in a certain market or neighborhood, the market rents are going to be within a couple $100s of each other max. Like there's not a big swing and there's not a lot of different things you can do, which is why you don't hear a lot of people raising a lot of money for single family real estate, right? And long-term rentals particularly.
Yeah, it's one of several reasons, but I think that that makes it compelling to people that don't want to make a full-time thing because they can just buy it. But like, let me use a more pronounced example. I found out about someone that I heard about that had a Bitcoin fund. And I was like, okay, cool. Like, what's the fun? He's like, we just buy Bitcoin and we split the profits 80-20. I was like, are you kidding me? Like anyone can do that. There's no value add there, right?
Yeah.
So like, that's like, to me, that's like not a real value add. On the other side, you have something like short-term rentals or something like senior living, which is essentially just senior living in particular, very exhaustive, nuanced industry where there's regulatory burden. And it's essentially, you're running a cruise where everyone's like, sick. It's like a very dense operational business. And so from what he's really saying, and you said a good job of it, I'll just say it, is that the more complicated, the more operationally intensive, the more there's a difference between a mom and pop owner and a best in class owner. But, and this is my perspective on this, having done a lot of this stuff, you got to be careful because those rocky waters can look good from afar. But when you get in there, it's like, there's a reason other people aren't doing it, in certain cases, not necessarily the short-term rental space, but man, I mean, there's a reason you don't see a lot of really savvy players doing senior living deals. And I had to learn this the hard way. And I'll just be transparent about that. There was so much investor appetite for senior living, and there still is, but there was so much before COVID. And you get in there, it's like, man, it's gnarly business. But you do have this opportunity where you can see insane, 38% cash on cash returns. You know what I'm saying? So we kind of looked at everything and we thought, I'm a biased person. You can tell by the way I speak. I'm very convicted and unfortunately not convicted. I'm very, I have a lot of
high conviction on your beliefs, right?
On my beliefs. But like you, I have been recording myself talk for years. So you can go back and listen to myself make mistakes all the time. But like my vision is that I just like multifamily because it's a good balance of both, right? You got really savvy players. You got a lot of buyers and sellers. You got a lot of friends that can help you solve problems. At the beginning of my career, I would go around and say, hey, what's the most underserved industry where no one's paying attention? How can I get the highest cap rate? Then you lead yourself to find out, well, maybe there's a reason people aren't buying mobile home parks 80 minutes outside of this tertiary market. You can find a 12 cap, but who's going to buy it? Who's going to sell it? Who's going to be the lender? So my point is, that's how I kind of got into that. And there's a spectrum out there and it's a personality type thing. It's, there's different nuances. Do you want it to be hyper scalable? Do you want to build $1 billion portfolio? Or if you buy 10, are you going to be happy for life? Do you want to be in a competitive market? Now that seems silly, but just to answer your question, I prefer to now be in really competitive industries because I want to be able to solve problems. There's so many people I can call if something goes wrong. So that's how we got to multifamily in Phoenix. Goodness gracious, probably the most competitive market, the most competitive asset classes, but that's how we want to play the game.
Yeah, I love it. I always tell people in short-term rentals, the people are saying, hey, listen, all these markets are so saturated. They're so competitive. That's the problem in the market right now. There's just too much. There's too much inventory, all these different things. And I always say, man, I would way rather play in a game because in my opinion, saturation, competitiveness is an indicator of demand as well. That means there's a lot of demand. That means there's a lot of dollars being spent. And my job is to be able to play the game better than other operators, play the game at a higher level and get my unfair share of that demand. It's a lot easier to go get your unfair share of demand in my opinion, if you're good at what you do, then go create demand where where it doesn't exist.
I know this, we're going long-winded on this, and I will wrap it up quickly, but I just want to say that like what you just outlined, like looking back on my career, I wanted to be a person of influence. I wanted to uncover something unique and be like, you're never going to believe it. I, Hunter Thompson, the slacker, found this thing and I'm right, and watch it happen. But then like as an ego thing, it's like, well, maybe that's not the way to play the game. I truly don't know the answer, but like that's something, think about in your own head. How are your biases impacting your ability to see the game? And the more you think about that, the more you think about your decisions, the better of investor you'll be.
Love it. Yeah, totally agree. So listen, this has been a really good conversation. One thing that I think that is like, if we could kind of put a bow on the conversation, but it's something that I think a lot of people wonder about when they're raising capital is, who should I go to, right? Who do I talk to? And it's not, I think and you tell me if I'm wrong, but I think in the beginning, we think that we could just kind of, everybody's going to be interested in our stuff. And it's a lot more important, in my opinion, to people that already have interest in what you're doing are going to be a much better and easier conversation. And I prefer talking to people that are actually more sophisticated than less sophisticated. And I don't mean that by the like smarter or dumber. I mean more sophisticated and educated in what we're doing, because they're, the interest level is there. They have some level of understanding that there's always risk in what they're doing. And like, because I've talked to somebody before on a deal, I was in a development deal, and he said, I'm going to go to, I know this person, they're super wealthy. They don't even really know they know nothing about real estate and this and that and the other. And so they're not going to ask a lot of questions. And I was on the other side of the deal, and I'm like, those aren't the right people, right? You might know somebody that's really rich, but that they're not interested in what you're doing. So what are your thoughts on who should we talk to? Do we, does it matter? Can we just talk to anybody with money that wants to put some money into something?
Well, at first you got to do everything you can, because if you're getting started, you got to output is the name of the game.
Right.
So you can't just be like, oh, I don't want to talk to, when I got started, everyone say, don't do deals with your friends and family. I'm like, that's all I got. That's all everybody. So that's the only one I can talk to. So that's how I got started. You know what I'm saying? And my friends and family, I thought they were going to give me $500,000. Like the story I told, I didn't get $1. My mom is like one of my first investors, but all these other people that could invest didn't invest, even though they knew, liked, and trusted me. Yeah. And so what I had to do, what I spent my career doing, is how can I attract people that are already like on the cusp of investing or have invested in the past? And how can I nurture them? And how can I follow up with them without using my time as much as, automations and systems and processes? And that's what I really created. And a great way to do this, and I think everyone listening to this right now should do this, is start to build your platform. Yeah. The easiest way to do that is to buy a $300 microphone, a Shure MZ7, and think about 10 topics that are related to the kind of thing you want to invest in. And specifically, if you've ever heard someone say they can't invest with you because of a specific reason, I would just do 10 8 to 12 minute podcasts answering those questions, overcoming objections, and put it up on your website. And that's the beginning of your platform. I'm not saying you need to do a show a week or 4 shows a week like I've done 1,000 episodes. That's a big ask, but just do 10, because it'll help you communicate and it'll be the beginning of your platform. And you may even attract a couple of people. But what will for sure happen is that the next time you talk to someone, they're going to see that you effectively have a podcast. They're going to click around and listen to a couple of things. It's going to make your sales process a lot easier. And then you can go, wow, Hunter was right. I should start doubling down on this. Maybe it's not podcasting. Maybe you want to do a YouTube channel. Maybe you want to do Instagram, whatever it is. Start creating content that can be shared one to many and bring people into your world. And that makes the whole business run a lot more smoothly. And that's how I went from failing on my first capital raise to raising $100 million, almost all from people that I didn't have a personal relationship with. And that's the name of the game. You've got to do it if you're going to scale.
Yeah, 100% agree. And I'm always, maybe a little harsh to some people. Sometimes they say, hey, Shawn, I've got this deal. I need some money. Who do I talk to? I've got the best deal around. I said, and I always tell them, private money and raising capital is a relationship game. And it's one of those things that if you haven't been building those relationships, it's hard to get money from somebody when you're like, hey, I've got this deal under contract and it's expiring next week. I need the money, right? That's a red flag for a lot of investors. We have to start somewhere. Like you said, you usually start with your sphere of influence, the people you know, the people that already like, know, and trust you. But your job, if you're really serious about this, is to build a community of other people that know, like, and trust you that are not necessarily built around deals. And in my opinion, this is why I say I don't feel like the community is typically built around individual deals for the most part. It's around, hey, here's what we do. Would you be interested in a deal if we find one? We do a couple deals a year. I think you even mentioned that in your book, right? This is, and you start to build those relationships. You stay top of mind. You educate them on what's going on in the market, educate them on what's doing, so that when you bring them the deal, they're already a warm audience. They've already got a relationship with you. And a lot of times it's amazing how fast you can build a relationship with people on websites and on podcasts and on different things. And I think it's a great piece of advice. I don't know. And I know you have this because you've got a podcast like we do, but I mean, how many times do you meet somebody at Raise Fest or an event you go to and they feel like they already know you because they've listened to you, right? They've already, like some people I haven't even met in person yet, and they know everything. They ask me about my kids. They ask me about my wife because they heard me talking about it, and they feel like we've got this relationship, and I love that. But that's something very similar of what you do when you're raising capital. You're in the relationship business, and you're not just in find a deal, go raise money. That money comes from those relationships you're building, and they have to be intentionally built and intentionally nurtured and staying top of mind with and providing value, so that when those right deals come around, you're not searching for the money, because I think that new capital raisers, they sometimes wait on that skill set to start building. And I think you build that the minute you know you want to get into this game.
Yeah, 100%. And the more you do it, the faster you do it, the faster you dig that well, the more quickly you can tap into it. And unfortunately, what a lot of people do is they wait until they have a deal and then they start this process. And you should start right now. Like what I talked about in the podcast, you should do it today so that you can tap into the well when you have a next deal.
Yeah, 100% agree. Because I know you've got a Rolodex of investors that will invest with you. I've got a Rolodex of people. If I needed, a partner on a deal, they would do it. I don't typically ever raise money. Like I said, I've done equity deals with other people, but I don't ever go out and raise money. But I could because of how long we've been doing it. I have people that are like, hey, I want to do this with you. If you're open to it, let's do it. But those people are not going to give money to somebody else that calls me and says, hey, I have this great deal. And I say, hey, Joe over here has this deal. Would you give them money? They're like, I don't know Joe. I'm not giving Joe money. Well, Joe's got a really good deal. I looked at the deal. It's really good. Well, I still don't know Joe. Right. And so, and I think that that's where people realize it's kind of a double-edged sword. I always say a really good deal will never have a problem finding money, right? And I truly believe that a really good deal, money is going to be available somewhere. It's people want to be a part of good deals, but you might not be the one putting it together. That deal will find the money, but if you don't have the relationships with the money, that deal might go to somebody else. Yep,
100%.
Awesome, Hunter. Well, listen, man, we'll wrap it up for today. This has been a really good conversation. I appreciate you joining us. Again, you guys go check out Raise Fest. It's in February, right, Hunter?
That's right.
So that's if you are interested in this world, go start surrounding yourself with people that are in the world doing things you want to do. You're listening to a guy that's raised over $100 million. That's a lot of dollars, and so that's a lot of deals. Been doing it for a long time. Can share the ups, the downs, everything in between. Our goal is always to help people walk into these games with their eyes wide open, not sugarcoat it, and tell you the things that have worked for us and share our view of the world. And Hunter, I appreciate you joining us and doing the same thing. And so, and then also on a daily basis, go check out the podcast, go check out the book, and all great things and great places for you to check out. Again, the podcast is Cash Flow Connection Real Estate Podcast. And then the book is Raising Capital for Real Estate. You can get it and get started right away so that when you go join them at Raise Fest, you'll be a little bit, a few steps ahead in the game. And so, guys, we're going to wrap it up today. We know how valuable your time is. We always appreciate you joining us. And at the end of every episode, you guys know I ask you two favors. The first one is we don't run ads, we don't run sponsorships on this show. We try to keep them short, sweet, to the point, good information. So if you got any value, the only way this show grows is if you share it. So if you know somebody else would like to walk into these games with their eyes wide open, share the show. We always appreciate that. If you got more than 30 seconds, like it, review it on whatever platform you're watching or listening on. And the final, most important thing that I ask you guys at the end of every episode is to pick that one thing you can do today to start building that life you don't want to take a vacation from. Cheers, my friends.
Thanks for joining us on this episode of the Vacation Rental Revolution podcast. Share this with other people you think need to hear about it. And don't forget to subscribe and leave us a review. Hey Grace, is there a website? Yes! For more amazing content and expert advice, visit Vodacy.com. Thanks for listening, and we'll see you on the next episode.